Hello, everybody. This is Eric Bugarin, president of Marvec Inc. I, along with Vivian Coronado, Cynthia Pereira, Arturo Molina, Magda Aguilar, and Regina Thornton, will be giving you a presentation on our company, Marvec. So Marvec, we are a Rolex luxury item type company. That's the type of strategy we pursue. What sets our items apart is our high price and the high model quality and features. Our goal is to invest heavily into research and development to produce higher end models. For inventory, we have a 20% safety stock inventory policy, and the majority of our production is based in Area 1, the home area, and we have one overseas plant in Sereno to help supply that area's demand. Another characteristic of our company is its high equity, high cash reserves. We finished year 6, quarter 4 with the highest cash reserves out of all the competitors. We don't believe in taking loans, and that is to avoid debt. And we advertise heavily in areas where we want to increase sales. Now I'll be conducting a SWOT analysis of our company. One of our strengths, as I mentioned earlier, is our high cash reserves. We're able to fund plant construction/expansion without the need to incur debt. We have had stable growth, and we have a high market share in Sereno, which is a developing country. Weaknesses. We have poor sales in Area 1, high ending inventory in Area 1, and low return on investment and stock price. Opportunities. We have a new model number available, which is model number 5. Increase R&D spending, research and development, to produce more higher end models as well as qualities and features. And we also have an opportunity to lower ending inventory because we just released a new model. Threats. Low consumer demand, overproduction. Low consumer demand has led to an overstock in inventory in Area 1. We were unable to forecast correctly, and as a result, we were stuck with high ending inventory balances in Area 1.
Hi, my name is Cynthia, and I will be presenting the finance strategy for year 5 and year 6. For the most part, our actual finance strategy for year 5 was consistent with our forecasted strategy for year 5. We invested $1 million in 3-month certificate of deposits every quarter in year 5. We earned a total of $52,000 of interest income due to the investment of CDs. We also bought back 500,000 shares of stock in year 5, quarter 4, which cost the company $660,000. The reason for this repurchase was that we felt that we wanted to increase the value of our stock by repurchasing the maximum amount allowed to buy back. The result of the stock buyback in year 5, quarter 4 was an increase in income to equity from 3.3% to 5.5%. We also paid dividends to our investors in year 5, quarter 3, as opposed to quarter 4, because we felt that we had more than enough cash on hand and we wanted to reward the investors. We paid 3 cents per share for a total of $225,000 as opposed to what we expected to pay in our 2-year plan, which was $375,000. We saved $150,000 in paying dividends earlier. In year 6, we continued to invest $1 million in CDs every quarter as planned. The income generated by the CDs was $59,000 as opposed to $77,000, which we expected in our 2-year plan. We plan to buy back 1 million shares of stock in year 6. However, we decided to split the buyback in years 5 and 6. In total, we spent $1.3 million in buying back the shares of stock. We had anticipated spending $1.7 million in buying back the shares, which is $465,000 more than we actually spent. In both years 5 and 6, we always had enough cash on hand and did not need to take out any bank loans at all. Our company always had the most cash compared to other companies in our industry. Looking back at the past 6 years, we should have bought back more stock and paid more dividends in order to increase the value of our stock. This is what we will keep in mind in year 7 and beyond.
My name is Arturo Molina, and I'll be going over actual versus performance targets. Our initial projections going into years 5 and 6 were based off of an average annual growth trend. This means that we looked at the different variables and their final values for years 3 and 4, and we took the average growth rate between the two and added the percentage to the last year's results. This method of projection was fairly accurate for year 5. Year 6 was slightly more difficult to project as there was a shift in the market or drop in sales across the board. Had the market stayed on its initial trend, we believe that our projections would have maintained their accuracy. Although there was this discrepancy and/or oversight in year 6, the only variable that was dramatically affected was total net income. Other than net income, no other factors exceeded a variation of 25% or more. Our strategy as a whole was to continue growing at a safe and sustainable rate, which is to say that we were not trying to be the highest company in volume, but rather the most stable with a long-term growth strategy. I think that we were able to achieve this by maintaining stock levels within a 20% backstock, a median pricing strategy, and steady research and development. In years 5 and 6, we made strides in further developing our research and development and increasing market share through innovation and distribution of dividends. Changes were marginal, but increases nonetheless. If there was one thing that we could have improved on, it was utilizing reports more effectively and acting with a sense of urgency. In retrospect, we noticed that there were a few missed opportunities in releasing new models, as well as purchased industry reports being underutilized. Other than the above aforementioned, we seem to be the most stable throughout the process out of all the companies, with no extreme highs and no extreme lows.
Year 6 for Marvix was a good year. It had better actual figures than we had actually forecasted. Higher sales to customers up by a 77%, although it does results in a lower gross profit by a negative 5%. Overall, we did well. Budgeting on operating expenses, we forecasted more by a 47% than actual. Operating profit better than anticipated, up by another 34%. Foreign currency adjustments really helped, so that was 140% of a difference. Now, for a comprehensive income, that was 95%. So overall, it was a good fiscal year for Marvic. Looking at year 6 balance sheet, the variances varied by a lot as well. Cash balance varied by 89%. Total fixed assets had a negative impact by 30%. Total assets was a negative 14%. Total liabilities another negative 0.16%, while total equity was a negative 4%. Year 6 for Marvic with the cash flow variances was much better than anticipated. Accounts collected up by 277%, net operating cash flow up by 59%, beginning cash balance up by 660%, net cash flow up by 59%, while ending cash flow was up by 314%.
Hi, my name is Regina Thornton, and I'll be discussing the peer comparison for year 6. The main factors that contributed to a relatively low return on asset for the year were that we decided not to issue more stocks, and we were very mindful of the amount of inventory as well as cash we had on hand. The main factors that led to a relatively low return on equity, again, were the fact that we were mindful of the amount of cash we had on hand as well as inventory. As compared to the industry, The reason for our company having a relatively low market share were our decision to customize the product models to each area. However, our consolidated sales toppled the industry for the year. The reason for our stock price being relatively low as compared to the industry for the year were our decision to continue to pay dividends, giving our investors faith in our company and our great sales numbers. The reason for our fair unit production cost structure for the year were the fact that the first 3 quarters grew steadily until quarter 4, where our UPC took a steep increase as a result of the increase of labor costs. The reason for a relatively low net income is our decision to tightly manage our spending to keep enough cash on hand to be flexible with the market.
Hi, my name is Vivian Coronado, and I'll be taking care of the functional strategies for the marketing department. Product pricing. Our actual product pricing was very different from our plan due to the fact that by the middle of year 5, we launched a new model that did not meet our sales goals. That model caused the company to have significant high levels of inventory. By the end of year 6, we decided to decrease the price in hopes of increasing sales. By the end of year 6, our actual price was lowered by 5% than our planned price. After consideration of previous numbers, the 5% difference was found to be a better fit for our company. Number of salespeople. The number of salespeople in Marvick was below our projected numbers. Our company did not want to hire any more sales representatives. We did not want to overspend in training costs, which then gave us that advantage of increasing commission rates. Salary levels. Salary levels were consistent throughout year 5 and 6. On the other hand, our salespeople commission was 20% above plan. We decided to increase commission base because we wanted our sales rep to further gain loyalty with the company. Advertising spending. Advertising spending was above plan figures in year 5 and 6. In year 5, we added a new model with new features and qualities. Therefore, we wanted to expose the product to a broader range of customers. Also, in year 6, our actual advertising spending was above planned spending. This was due to the fact that we launched a completely new models with renovated higher qualities and features.
Marvick Inc. would like to thank you for watching, and we hope to continue working with you in the near future. Thank you.